Joining me now is John Stolfus, Chief Investment Strategist at Oppenheimer Asset Management. John, it's good to see you again. And let's talk about these financials a little bit. What's your kind of thesis going into this earnings season?
Well, first, thanks for having me on the show, Kelly. Great to be on CNBC with you. Well, going into this season, of course, we've got the Journal over the weekend says that the consensus is looking for a little over 6% negative on the earnings for the quarter overall for the S&P 500. We're thinking when it comes to the financials, it'll be very much an idiosyncratic kind of time that we're going to be going through. With even within the big banks, we will see some winners and others not so much winners. But we downgraded financials in the S&P 500, moving from an overweight to just a market perform. So it's not a severe downgrade. Our thoughts on that were essentially you've got a market that is very much subject to day-to-day news items. Bears always ready to grab any catalyst to sell anything lower. And so why be overexposed to the financials right now? But intermediate to long term, you got to own the financials because everything runs on credit.
Well, I was going to ask if you kind of got caught by the same sort of thing that everyone else did, which was, financials should have a great year because rising interest rates and all. And then we all went, okay, or maybe not because this is the flip side of the coin. So I suppose to put it differently, my question would be, why keep them at sector weight? Why not go to underweight?
Well, because the S&P 500 is the large caps. It's the big ones. And within that sector itself, you've not just got pure banks, but you've got banks that are very much diversified in terms of whether it's investment banking or it's trading, what have you. They really offer a diversified approach to financials. We didn't get caught up as much in the regionals because while we had exposure and indices to the S&P 600, which has quite a weighting in regional banks, we didn't extend ourselves in regionals. We were concerned that they were just going to have trouble with interest rates rising to a point where mortgage people who needed mortgages were likely to back away before moving forward.
Sure.
So we weren't terribly surprised. We were surprised, by the way, to the extent that regulators had really taken their eyes off, apparently, SVB.
Let me ask you about utilities, which is the only place that you're kind of have a lower weighting than the broad market. Why is that?
Well, related to the Utes, we think it's, you still have an opportunity here to see the Fed raise further. We don't belong to the camp that it's at any sure thing for the Fed to either pause or to actually cut rates this year. At least for the first half, we expect them to continue tweaking higher so long as the inflation rate remains concerning to them. Longer term, we don't know if they're really going to go to this 2%. We think they might have to settle on 3%. We can only remember that many economists were actually complaining that 2% inflation was not enough to really see an economy the size of the U.S. grow. That's sort of like be careful what you wish for, right?
Right. So looking at things more broadly for you, you're still, 75% in stocks, 15% fixed income, little bit of cash, little bit of real estate, no alternatives, little bit of commodities. I mean, is this a portfolio allocation that would maybe work better in 2019 than 2023? Or why don't you have bigger kind of shifts here towards some of the, some of the things that people say, and we know how wrong-footed that can, we can get caught by that, but that they say other types of asset classes might perform better, maybe even fixed income now to the point that you're making. But you're just curious about that.
Yeah, Kelly, at the beginning of the year, everybody was downplaying what was going to go on with technology. We were very well exposed to technology. From the lows last year on October 12th, a lot of people were predicting the death of stocks and growth, and we maintained garpier growth and growthier value. We've done quite well with it. We think that equities, when we look at it for intermediate to longer term investors, especially in a world where a lot of people are investing for retirement and are looking towards retirements that may last much longer than they might have ever expected, equities are an essential place to be. And so that's why we're not day traders. If we were trading on a trading floor or in a trading room or DIY investors at home
Sure.
for the excitement, we might very well be moving around more actively. But our thought is here, this is just the end of free money. That's what the Fed is saying, and it's a good thing. It means bond issuers have to pay for the privilege of borrowing money, and people who buy bonds get something back. And historically, I've been in this business, it's going to be 40 years in a few weeks. I can remember where interest rates were actually close to double digits and equities were moving higher.
Wouldn't that be nice?
Yeah.
Maybe. I don't know. John, really appreciate your time. Thank you for bringing your perspective today.